it's Ty Crandall with Credit Suite with some more loan broker training for our business loan brokers. Today we're going to dive in and talk a little bit more about revenue and cash advances, how these products work, and what they can do to help your borrowers easily and quickly obtain financing. So when we talk about financing that's based on cash flow, what we're talking about is lenders that will approve borrowers based on the cash flow going through their business. Now, sometimes this could be tax returns, but in most cases nowadays, especially with revenue and merchant cash advances, this really has to do with a review of bank statements. So what the lenders are typically looking for is responsible bank management. So they're looking to make sure that people have positive cash flow, that they're not overdrawing their account and having non-sufficient funds. Basically, that they are managing their bank account responsibly. So we're looking at consistent deposits, not just random and few deposits, but consistent deposits. Positive cash flow, where more money is going in the bank account than coming out. Low to no non-sufficient funds. Again, in any kind of loan, the lender's most concerned of the borrower's ability to repay the loan. So if they don't have more money going into the bank account than coming out, if they're overdrawing the bank account, these are good indications they may not be able to pay the loan back. And this is the same thing with having a positive ending bank balance, making sure that they have money left over at the end of each month. So some financing does look at tax returns, as I mentioned. When you start to get into alternative SBA loans, even some term loans and lines of credit, they'll ask for tax returns. And some lenders will even give the customer better terms when they provide tax returns. But in most cases, a lot of these lenders for cash advances are mostly looking at bank statements. And again, if they do have 1 to 3 years worth of tax returns, that could definitely help as well. But when they are looking at tax returns, lenders are typically looking for revenues increasing from year to year, and they're looking to make sure that the tax returns have some kind of actual profits on them. The difference for a borrower being able to get a good long-term loan and credit line oftentimes comes down to whether they're showing any kind of profit or no profit or all profit at all on those actual tax returns. So when we talk about these revenue cash advances and merchant cash advances, and we'll talk a little bit about both and talk about the difference between them, this is really fast money. This can be secured in 3 to 7 days. We've even secured financing for clients as little as 24 hours. It's very easy money to get as well. Remember, when we talk about the 3 C's formula of lending, somebody either needs cash flow, credit, or collateral. Now, if they have one of those C's, they typically don't need the other. So in this case, we're basing the approval on cash flow. That means that collateral and credit don't matter, so they can get approved even if they have very low credit scores. Matter of fact, a lot of lenders don't pull credit, and some of the lenders that will pull credit are looking for scores as low as 500. All that's needed for approval is 6 months worth of bank statements and merchant statements for reviews. Now, this differs with some of the lenders. Some lenders will actually do this electronically. They'll use artificial intelligence to come in and evaluate the bank statements, even pull the bank statements directly from the online bank account from the borrower. Others will make you submit 6 months worth of physical bank statements and or merchant statements. They like to have both for review. The actual merchant statements that show the credit card approvals, transactions, deposits, and the bank statements that show all amount of money that's going, all deposits going to the account, even ones that are not credit card. Now, usually loan amounts are equal to about 12% of annual revenue. Again, this really fluctuates per lender. Some, based on risk, might only go to 8 or 10%. Some may go higher, but on average, you're typically going to see that a borrower is able to get about 12% of their annual revenue advanced to them. So they have $200,000 a year in annual revenue, and they're looking to get an advance somewhere around $24,000, for example. Now, a lot of these lenders are doing daily paybacks, which means that payments are withdrawn daily from the business owner's bank account. But with lower risk scenarios, borrowers can also be provided weekly or monthly paybacks as well. So with really low risk scenarios, then it's not uncommon to see lenders offer monthly payments on this. And for medium to low risk, it's also common for lenders to be able to sometimes offer weekly paybacks instead of daily withdrawals from the business bank account. Now, these are short-term loans, typically 6 to 18 months on average. A lot of them may go as far as 36 months with lower risk borrowers. Usually in the beginning, the lender gives the borrower lower terms or shorter terms, like 3 to 9 months. And then as the borrower pays back their first advance and comes back for more money, the terms typically get longer, 9 to 18 months. And again, for really low risk situations, you can even see these go as far out as 36 months, but typically won't see them go longer. Now, typically loans amounts go up to $500,000, and again, This is with some lenders. A lot of lenders are up to about 400 or 500,000, but there's a lot of niche lenders that may lend in certain industries that have an amount lower than this. But again, 400 to 500,000 is the norm of how high lenders will go. We find that over 70, nearly 80% of people come back for more money after they pay off the first advance. So it's very common for borrowers to come back, renew, and get more money. And they could typically do this when they pay about half of the amount that they've borrowed back. Rates fluctuate wildly on this program. We've seen rates as low as 8%, 10% on really low risk borrowers, and then you could see rates as high as 50, 65% with high risk borrowers. Now what this means is it means this program can work really well for people that are low risk and really well for people that are high risk that might not be able to get financing through other means. Now risk factors that affect rate include time in business, the industry they're in, the quality of their consumer credit, how they manage the bank account, the ending balances, etc., etc. There's many factors, but see, these are some of the core factors that determine rate. And fees and interest are 100% deductible, tax deductible, as with all financing. So it makes it easier for the borrower to write off the taxes as long as they can afford the payment, which means in a lot of cases with this option, lenders will give the borrower options of whether or not they would like a longer term and higher rate or a shorter term and actually pay a lower rate. In most cases, a borrower is going to choose the longer term and take the higher rate because that's what will give them the lowest payments. So a really good program because a lot of options are available for the borrower. Now, most of the times lenders are not going to want to see that they're currently in trouble, such as a bankruptcy or very recent liens. They need to have about 120,000 or more in annual revenue. That's about 10,000 a month. Now, with compensating factors, some lenders will go as low as $5,000 monthly on revenue cash advances. And the main difference between these two is revenue cash advances really look at everything in the business bank account, cash deposits and checks, whereas merchant cash advances are just looking at credit card transactions. So with merchant cash advances, it's common to see lenders that'll go down as low as $5,000 monthly in revenue. But again, the norm here is $10,000 monthly in revenue, and the norm is also to be 12 months in business. Now again, with some compensating factors, some lenders will go as little as 6 months in business, and compensating factors can be really good personal credit, low risk industry, really good bank account management, etc. They're going to look for more than 6 deposits monthly. Again, this wildly varies between lenders of how many deposits they're looking for, but it's consistent deposits, not ones like real estate agents that may only have 2 or 3 deposits in the account. They want to see less than 10 non-sufficient funds. Again, wildly varies this number of non-sufficient funds from lender to lender. They're looking for that positive ending bank balance at the end of each month. And they're also looking to make sure, and this also can provide you with very lucrative payouts. As a matter of fact, this is one of the most common type of financing that loan brokers take advantage of because it pays out more money than any other program that we've really seen when it comes to business financing. So some lenders now offer credit lines with this program. These lines are usually for about $20,000 or so in addition to the loan they'll get. So what happens is now that these loans have become so popular, there are new lenders that will lend in second or third position behind the first position. So some lenders don't want other sources to come in and offer a second loan after they just offered the first. So what they're now doing is offering their own second loan to the borrower, and they're really doing it through a form of a line of credit. I probably shouldn't refer to that as a loan. So lenders oftentimes want to see good credit for this, 680 plus, and they often may ask for tax returns. But it's a really nice option for low risk borrowers because they're able to get the primary loan financing, and then they're also able to get the line of credit as well, which I should probably indicate here that theoretically this isn't really a loan because what the borrower is actually doing is selling their future revenue to a lender at a discounted rate. That's how this process really works, although it's oftentimes referred to as a loan. That's inevitably what's happened is that the actual borrower is selling their future revenue at a discounted rate. But again, for the rest of this trading, and oftentimes you'll hear me refer to this as a loan. So revenue looks at all deposits, and again, that's the difference between revenue loans and merchant cash advances. Revenue cash advances are looking at all deposits in the bank account, cash and check, so somebody can typically qualify for more money, whereas merchant cash advances tend to be a little bit easier to qualify for, but they're only looking at credit card deposits, typically only Visa and MasterCard deposits, and then American Express offers their own financing if somebody is having American Express deposits. So again, MCAs work exactly the same. The only difference is for merchant cash advance MCA, they're looking at credit card deposits. Only Visa and MasterCard is typically what they're looking at, and American Express will oftentimes lend to that borrower direct based on their deposits, but not a lot of what loan brokers do with this, with American Express, is as easy as it is for you to work with a merchant cash advance that's usually looking at Visa or MasterCard. MasterCard deposits. Now, PayPal and Square will also lend money based on deposits into these accounts. For loan brokers, this isn't really going to help you. You're not going to earn money, at least at this point in time, on this financing. But I'm a really big advocate on doing what's best for the borrower, even if you don't make a dime on it. And we advise our borrowers and our clients to get set up with PayPal and Square early in their business, one or the other, start running part of their transactions through there, because PayPal and Square make it really easy for borrowers to be able to get money through them. They'll even lend as much as 30% of deposits in really low set fees in a lot of cases. So great opportunities for the borrower. If you really want to do what's in their best interest, advise them to set up a PayPal or Square account and start running some transactions through there. That money still gets deposited in the bank account, so it still opens up revenue options for them. But again, it opens up financing through PayPal and Square as well. Even though you may not make the money, it's still a great options for borrowers to consider because of the amount of money they can get and the flat and cheap fees. So remember, industry restrictions will apply. Okay, this really differs between lenders. I think that lenders have defaults, all have their own kind of defaults, and they kind of tend to stay away from certain industries based on their own default statistics. And then again, some industry restrictions will apply, you'll find, with most lenders. And loans are based on bank accounts, not total revenue. So if they're operating more than one bank account, then they're only going to look at one bank account to determine the deposits. So again, it's okay for a borrower to have multiple bank accounts. They just want to run all their deposits through one and then take the money out of that and transfer it to other accounts such as money market accounts for the purpose of saving. Now, there's no prepayment penalties in some cases. So what happens is that means the borrower can pay the money back without paying all the interest that's due. This is a really good opportunity for people that need the money to make it to make a purchase, to have a transaction that's going to immediately give them a great amount of money in return, because this allows them to pay that off without paying all that interest. And first and second loan positions are available, as I mentioned. Also, it's now not uncommon to see third loan positions to help borrowers get even more money. Approvals are in 24 hours with one-page application, 6 months bank statements with most lenders. It's very fast, easy money to obtain, and again can fund as little in 72 hours. For renewals, if they've already did a first loan and they're looking to get a second advance from that same lender, the lender usually only wants 1 month's bank statement and can fund that fairly quickly within 24 hours. We've done that to help clients actually meet payroll. And again, the money is used to expand the business, not for slow times. This is very important for loan brokers to know and understand. Look, there's a lot of financing out there for borrowers, and in our training we cover a lot of this, but this is the kind of money that a borrower is going to specifically use for the purpose of investing into the business to increase the revenues and net profit of the business. Okay, meaning that this money is not the cheapest money that they're going to get just to have the money laying around. They need to invest the money to something that's going to grow the business, grow the revenues, and they can use the growing revenues to pay for the money that they're borrowing. Okay, it's not for people that have slow times, for example. And if you try to offer this kind of financing to people in those scenarios, you're probably going to see them flip out because it's really not right for them. They don't need high interest rate money in a situation where they're trying to get through a slow time. So again, be wise with this. It's best used for borrowers that are looking to expand and grow the business and invest into things that will generate revenue, not for slow times. So additional details we already talked about: approvals within 24 hours, and actually that seems to be a repeat of the slide. So that's a lot of what you need to know about revenue financing and merchant cash advances. That gives you a basic idea of how these programs work: rates, terms, qualification, everything you need to know. Again, if you have any other questions along the way, get in touch with us. 877-600-2487, info@creditsuite.com. And don't forget to access your free training for loan brokers at creditsuite.com/loan broker.